Donor advised funds got sold as the easy answer for the last 10 years. For North Carolina families with 2 million or more and a spirit of giving, they probably still are. For North Carolina families at or over 10 million, they're probably the wrong tool though. Here's the honest breakdown for North Carolina families and the CPAs and advisors that are guiding them. A donor advised fund, or a DAF, is a charitable giving account. Think of it like a brokerage account that is tax enabled for charitable contributions and deductions. You can contribute assets to this donor advised fund, could be stocks or cash, appreciated securities, and you get a deduction in the year that you contribute. The money inside that account can continue to grow. It can be continuously invested in securities, can be bought and sold without consequence. And generally the growth on those accounts are not taxed to you or attributable to you. Now, while you're here and through directions after you're gone, you can actually recommend or direct the different types of charities that can be benefactors of this account through what are called grants. Then there are sponsoring organizations like Fidelity Charitable or Schwab Charitable who administer the accounts while you're here and after you're gone and give out the grants according to your direction. If these points captured your interest, click the link below to talk about donor advised funds. Now, tax deduction timing is really the whole game when it comes to donor advised funds. The point of a donor advised fund is to contribute on a certain timeline and maybe give on a different timeline so that we can realize the charitable deduction benefit of the transfer at a specific time, but give in maybe a different amount over time. So for instance, if you give $100,000 in 2026 to your donor advised fund, you get that $100,000 deduction from your taxes in 2026, but you can also give it in smaller installments over time instead of cutting a check directly to a charity and getting the deduction directly. If we combine the use of this tool with the donation of appreciated securities, it means that we can give substantial value without suffering the tax consequences. Now, with assets in the $2 to $3 million range, the donor advised fund makes a lot of sense. And it's largely because it is a low maintenance, low compliance tool for the average well-to-do family. All that's required is that the donor advised fund give at least 5% of its principal in qualifying grants in any given year. Barely any compliance requirements otherwise. Establishing a donor advised fund as part of your estate planning strategy is not highly complicated. Click the link below to get the process started. Now, with larger estates, say $10 million or more, a private foundation can make maybe more sense than a donor advised fund. A private foundation is going to be more appropriate for dealing with larger sums of assets, more complicated compliance goals, more multi-generational giving objectives, and establishing a longer history of charitable intent while you're here and after you're gone. Foundations can also give a lot more control to your family and loved ones rather than requiring Fidelity or Schwab to administer things for your benefit. We can employ family members as officers of the foundation. We can conduct more meaningful, direct charitable bequests and grants through the family foundation, but it still has the 5% minimum grant requirement that the donor advised fund would have, but it comes with more administrative costs and compliance costs. Now, these types of tools, whether it's a donor advised fund or a family foundation, are things that really need to be coordinated with your tax specialist, your CPA, EA, or tax preparer to make sure that you're timing the contributions correctly and that compliance requirements are being kept up to date. You could also coordinate with your financial planner or tax strategist directly to time things like business exits, IPO valuations, Roth conversions, and other types of income strategies that may have substantial tax detriment to you if not used in concert with charitable strategies. The worst time to utilize these types of strategies would be in low income years because we're trying to maximize the benefit of the deduction against higher income tax years. Donor advised funds are great tools for North Carolina families in the right scenario, but they're the wrong tool in some others. If you're giving $10,000 or more in annual charitable contributions and haven't ran the DAF analysis with your tax preparer, that's the coordination call. Click the link below. Protecting your family requires more than just standard documents. Schedule your consultation with our team today.